know that between the analysis paralysis and fear of losing money, it's hard to make a move, but at the end of the day, no one ever got rich sitting on money in a bank account. Recently, I was in New York City riding the subway, and I ended up chatting with this girl that I met. Inevitably, the topic of investing came up, and she said that although she didn't know much about investing, she had recently bought a couple $100s of Bitcoin. So we chatted about that, and as I got off at my stop, I couldn't help but think about how just a few years ago, whenever the word investing came up, most people would immediately start talking about stocks. But now investing means Bitcoin and a bunch of other things that never existed before. In fact, a lot of millennials and Gen Z invest all their money in crypto and nothing else. This girl I talked to on the subway was probably in her 20s, and I've had very similar conversations with at least 3 other friends who seem to think that crypto is the only investment worth looking into. On the other hand, older generations, people like my mom, my dad, they tend to stick to the more traditional asset classes of stocks and real estate. However, if you are investing only in crypto or only in stocks/real estate, you're missing out because each of these 3 asset classes can provide a combination of growth and income. So I think the best approach is always to first understand all of your options and then decide where to invest your money, especially given how the investing landscape is evolving as we go into 2022. So in this video, I'm gonna break down the pros and cons of investing in stocks versus real estate versus crypto. I'll debrief you on the market dynamics and economic conditions you need to be aware of right now. And finally, I'll leave you with some tips on how to decide where to invest your money in 2022 and beyond. If that sounds good to you, then keep on watching. All right, let's first talk about stocks. When it comes to investing in stocks, a lot of people fixate too much on trying to buy low and sell high. But what's often overlooked is that as a stock investor, you can also make money from dividends, which leads me to the first pro of investing in stocks, which is passive income. Since stocks represent a share of ownership in a business, whenever the company makes a profit, anyone who holds the company stock is entitled to a pro rata share of those profits. Meaning, if Tesla makes a profit of $5 billion in 2021 selling electric cars, and you own a few shares of Tesla, you should get a tiny piece of that $5 billion profit. This pro rata share of the profit is called a dividend, and dividends are typically paid quarterly. Now, if you don't want to invest in individual stocks like Tesla, you can also invest in index funds and ETFs, which hold hundreds and sometimes even thousands of different stocks. They're an easy way to get started investing in stocks, and as long as the underlying stock holdings within the fund are paying dividends, the fund will also pay dividends. Some good ones to look into are FSKAX, which is an index fund, or VTI, which is an ETF. Both of these track the total US stock market and have returned about 10% a year over the last 35 years. For more information on stock index funds, mutual funds, and ETFs, check out this other video here. I'll also include links to videos and anything else I mentioned in this video right below in the description. Dividends are paid into the same brokerage account where you're holding the stocks, and let me tell you, seeing dividend deposits come in never gets old. Literally nothing. Nothing makes me happier than seeing my money work for me and seeing those dividend deposits. Stocks are literally slices of ownership in operating businesses, and they'll continue to throw off passive income for you as long as you hold that stock. And this is whether the stock price goes up or down. For example, all throughout the month of September 2021, while the market was going down, my stock holdings were still paying me dividends. So if you're willing to keep the faith through all the ups and downs, you can generate big gains over a 10 to 20 year period while also collecting dividends all along the way. Not only this, but dividend income from stocks typically gets taxed at much lower rates than other forms of income, which leads me to the next pro of investing in stocks: favorable taxation. Income from a paycheck gets taxed at your ordinary income tax rate, which if you're in a high tax bracket, this could mean up to 37%, and that's not even counting state taxes. On the other hand, dividend income gets taxed at either 0, 15, or 20%. For most people, it'll be 15% unless you're in one of the highest tax brackets. The catch is that for dividends to get this favorable tax treatment, it has to be a qualified dividend versus an ordinary dividend. Luckily, most stocks and index funds in the US pay qualified dividends. So not only are dividends taxed favorably, but so are capital gains. When you buy stocks, you hold them for at least 1 year, and then you sell them at a higher price. That's what's called a capital gain. And capital gains count as taxable income. However, they're taxed much lower than paycheck income. Once again, 0, 15, or 20%. 15% for most people unless you're in a very high tax bracket. So moral of the story is not all income is created equal. Yet society mainly pushes you to study hard so that you can get a job that pays you paycheck income, which is the highest tax form of income. The fact that no one ever taught me this in school is just crazy to me. Yet another reason why I am so passionate about financial education. I have a whole nother video about the different types of income, so just click up here in the upper right hand corner to check it out. Obviously, stocks are a great place to put your money for all the reasons that I mentioned. However, these days, with stock prices at all-time highs, dividend yields are very low. Dividend yield is the dividend amount divided by the share price. For example, Apple paid dividends of 87 cents per share in 2021, and the stock price is currently trading at around 170, which equals a dividend yield of 0.51%. Not very high. If the stock was cheaper, the dividend yield would be higher. So as long as stock prices remain at all-time highs, dividend yields will remain low. That's why these days, people are finding other ways to generate yield, such as with cryptocurrency. I'll be getting into how you can generate yield with crypto a little bit later in this video. Of course, with concerns about rising inflation and higher interest rates, stocks might be due for a correction. And when that happens, stocks will start offering more attractive dividend yields. Something to keep in mind is that although inflation affects stocks negatively in the short run, in the long run, stocks are really good at outpacing inflation by well over 6% per year. That's because companies can pass on the costs of inflation to its customers by raising their prices, thus maintaining profit margins. So if you're worried about inflation, you'll definitely want to have some money in stocks. Next up is real estate. The first pro of investing in real estate is obviously the passive rental income. People are always going to need a place to live, and as long as you own real estate in a place where people want to live, you'll always be able to collect rental income. The catch is that you often need a lot of money up front to invest in real estate. Buying any piece of real estate is probably going to require tens of thousands, if not hundreds of thousands of dollars. Which leads me to the next pro of investing in real estate, the ability to use leverage. Leverage means borrowing money to buy assets. And this is major, because when you buy assets with borrowed money instead of your own money, you not only get to buy things that you couldn't afford otherwise, but you also get a higher return on your capital. Here's how this works. Let's say you buy a property for $500,000 and then you collect $30,000 a year in net rental income. So your return, or your cash on cash return, is 6%. But what if you use leverage? Let's say you buy a property for the same price, except instead of paying for all of it with your own money, you only put up $100,000 and you borrow the remaining $400,000. You still collect the same $30,000 a year in net rental income, but because you only have $100,000 of your own capital tied up in the investment rather than $500,000, your cash on cash return is 30% instead of 6%. This is probably the number one reason why real estate is and always will be an attractive investment. The ability to use leverage is a huge advantage, and real estate is the only investment where banks are literally lining up to lend you money to buy it. You won't see Bank of America trying to get you to take out a loan to buy stocks or to buy Bitcoin, but they'll be very happy to talk to you about taking out a mortgage to buy real estate. That's because real estate is a hard asset and it's in its own category. It's different from stocks and cryptocurrency, and it's just nowhere near as volatile either. But of course, the one major con about investing in real estate is that it is quite labor intensive. Buying real estate is not as simple as buying stocks or crypto, which you can just do in a few taps on your smartphone, because you'll have to meet with real estate agents, brokers, and once you buy a property, you have to deal with property managers, tenants, contractors. That is a lot to deal with. And this is exactly why I personally haven't gotten involved directly in real estate yet, although that might be changing soon. More on that in future videos. As of now, my only exposure to real estate is through REITs, or real estate investment trusts. REITs are essentially stocks of companies that own huge real estate portfolios. Holding REITs is like having second-degree exposure to real estate, since if the real estate held by the company goes up, the company's stock should also go up. REITs also pay out rental income in the form of dividends, and those dividends are headache-free. NLY and SRG are examples of REITs that allow you to invest in property without having to directly purchase any on your own. NLY looks pretty flat over time, but it pays a dividend yield of 10.4%. That means that if you buy $10,000 worth of NLY, you'll get $1,040 per year in passive income. So holding NLY has been a great way to earn some passive rental income. On the other hand, SRG hasn't paid a dividend since 2019, since it holds mostly large retail properties like strip malls, shopping centers, which haven't been doing so well in recent years. So whether you invest in real estate directly or via a REIT, you still have to do your research. Recently, real estate prices in many zip codes have skyrocketed more than 15%. This is in super hot places like Denver, Austin, Miami. So housing costs have been rising, which is actually a big reason why the CPI, or Consumer Price Index, has also been rising, contributing to inflation. Because shelter is actually the biggest component of the CPI. The main driver behind rising housing costs is because interest rates have been so low. Low rates encourage people who wouldn't do so otherwise to go out, borrow money, and buy homes. When the pool of buyers gets bigger but the supply of housing stays the same, that's when prices go up like crazy. With interest rates already at zero, rates can only go up from here, right? So I think with real estate prices so high due to low interest rates, when low interest rates start going back up, I think real estate prices would go back down. So personally, I think real estate prices are kind of at the top here. So unless I want to actually live in the property or the property pays for itself by bringing in enough rent to cover the expenses, I wouldn't be jumping into real estate right now, but that's just my personal view. Okay, and the third asset class is a much more volatile and new asset class, cryptocurrency. Let's look at some of the pros and cons of investing in crypto. Cryptocurrencies have drastically outperformed stocks and real estate in the last 10 years, with the top coins like Bitcoin and Ethereum turning even just a $1 investment into more than $1,000. In 2011, one Bitcoin was worth $1, and as of the recording of this video, Bitcoin is fluctuating around $45,000, $60,000. No other investment has grown in the last decade like cryptocurrency. As the oldest cryptocurrency, Bitcoin is probably the furthest along in terms of growth potential, but the general consensus is that Bitcoin is becoming a substitute for gold as a store of value, digital gold if you will. If that's the case, Bitcoin still has a long way to go. The market cap of gold is $10 trillion, whereas the market cap of Bitcoin is only $1 trillion. So if Bitcoin truly replaces gold as a better and more convenient store of value, then Bitcoin's price should grow 10x from here, at least theoretically. Moving right along to another feature I want to highlight about investing in cryptocurrency, passive income. Of course, you'd have to be living under a rock these days to not know of at least one person who made a fortune buying and selling cryptocurrency. But it's not as widely known that you can also generate passive income simply by holding crypto as well. Whereas stocks generate dividends and real estate generates rental income, crypto generates interest. Just like banks can make money by lending out its customers' deposits in exchange for interest, crypto companies can lend out its customers' crypto deposits in exchange for interest as well. An example of a company that does this is Celsius. When you keep your cryptocurrency in a Celsius wallet, Celsius will lend out your crypto to individuals, businesses, and exchanges, places that need to borrow crypto, and charge really high interest rates. And then they'll pass on about 80% of that to you in the form of rewards that you get every single week. I've been earning up to double-digit rates on some of my crypto holdings, and it's been pretty cool. If you want to get started with Celsius, you can join by clicking the link below this video. Be sure to use my referral code to get $50 in free Bitcoin when you transfer $400 or more. Once again, the link and referral code are below in the description. Also, if you don't yet know how to buy crypto, be sure to check out this step-by-step video right here. All right, so clearly the passive income from crypto is great, but the trade-off is that if you want to hold cryptocurrency, you also have to stomach some crazy volatility. In 2021 alone, Bitcoin went from $10,000 to $60,000, then back down to $30,000, and now it's back up to around $50,000. All it takes is for one tweet from Elon Musk for Bitcoin to drop 15% in one day, which is exactly what happened on May 12th when he tweeted that Tesla would no longer be accepting Bitcoin due to environmental concerns. That's why crypto enthusiasts have coined the term HODL. See what I did there? HODL stands for hold on for dear life, and if you're at all interested in owning cryptocurrency, you have to be ready to HODL. I learned this firsthand watching my Ether holdings go from $1,000 to $84 and then back up to $4,200. And who knows what else is going to happen from here. If you don't have the risk profile for these types of moves, I would think twice before casually putting your life savings into cryptocurrency. However, there are some ways to use the volatility of crypto to your advantage. One, you can dollar cost average. Dollar cost averaging is a strategy where you buy the same dollar amount of an investment at regular recurring intervals. This could be weekly, bi-weekly, monthly, whatever interval you choose. I've been doing that with Bitcoin, buying $125 every single week in Bitcoin, which means that each time I can acquire more Bitcoin at varying price levels. So the amount of Bitcoin that I get for my 125 will vary. When Bitcoin is high, my 125 gets me fewer Bitcoin. When Bitcoin is low, my 125 gets me more Bitcoin. See how that works? So dollar cost averaging automatically forces you to scale back when the market is high and to load up when the market is low. And best of all, dollar cost averaging takes all the emotion out of it. The second way to use volatility to your advantage is to hold your crypto in places like Celsius that pay you a yield on your crypto. That way, you're accumulating more crypto in times of falling prices without spending more of your own money. Then when the prices go back up, the crypto that you've passively accumulated by collecting yield will then be worth more. So it all works out. So volatility isn't necessarily something you need to be afraid of if you know how to kind of use it in your favor. A lot of people are saying that crypto is in a bubble right now, and they're probably right to some extent. But then again, everything is in a bubble because with all of the stimulus and money printing that's been happening the last few years, there's just a lot of cash sloshing around looking for a place to go, which drives asset prices up. That being said, crypto and blockchain, which is the technology behind crypto, are truly the future. So even if we are in a bubble right now and prices come down a lot in the short term, I personally think we're in the beginning phases of a long journey upwards. Still, that doesn't mean you should buy any cryptocurrency because there's a lot of weird coins out there that don't serve any useful purpose. And that is why you should stay tuned for next week, because next week's video is all about the 6 best starter coins to jumpstart your crypto journey. I'm going to explain the merits of each coin as well as how much you should consider putting into each coin. So hit that subscribe button if you're not already subscribed to my channel, and stay tuned for that video next week. All right, and now to wrap it all up, how do you decide where to invest your money? Stocks, real estate, or crypto? At the end of the day, diversifying by having some money in all three, I think is the best approach. So I'd start with a few index funds in a Roth IRA or other type of tax-advantaged brokerage account, and then have a bit of cryptocurrency on the side. Then when you have more capital and you're able to dedicate time and energy, then you can move on to investing in something like physical real estate. I know it's really tempting to try and go all in on crypto, but we need to look at the facts. Stocks have been around a really long time and they've generated a historical return of 10% over the last 100 years. Real estate has been around even longer, and that has generated a historical return of 5.5%. But then Bitcoin's generated a historical return of 85% per year, but that's only been over about a 10-year period. And then if you exclude Bitcoin, the vast majority of coins haven't even been around for more than 3 years. So although crypto is probably here to stay, it doesn't have a track record that we can rely on the way we have with stocks and real estate. All this to say, have exposure to crypto in your portfolio, but be smart about it. I would say limit your crypto to no more than 10% of your overall assets and invest the other 90% in the more proven ways to build wealth. If I ran into that girl on the subway again, this is what I'd want her to know. I know that between the analysis paralysis and fear of losing money, it's hard to make a move, but at the end of the day, no one ever got rich sitting on money in a bank account. It's up to you to take care of yourself financially, and the best way to do that is by putting your money to work. So hopefully this video gave you a good overview of the different investment options available to you. That is all I've got for you today. Please feel free to smash that like button and have yourself an amazing day. See you next week, same time, same place. Bye!